Good morning. I'm reporting from Atlanta, Georgia, where summer heat and market dynamics are converging in ways that demand your attention. The Southeast's largest metro is navigating a complex landscape shaped by Federal Reserve policy, inflation persistence, and a labor market that remains fundamentally resilient. Today we're breaking down what the numbers tell us about Atlanta's commercial real estate trajectory. Let's begin. The Atlanta metropolitan area is operating within a macroeconomic framework that favors deliberation over exuberance. The Federal Reserve's funds rate stands at 5.33%, and while that figure represents a measured policy stance, it continues to shape borrowing costs across every asset class. 30-year mortgage rates have climbed to 6.82%. That matters profoundly for commercial property valuations, particularly in the office and multifamily sectors where long-term debt financing remains standard. Consumer-level inflation is tracking at 3.4% year-over-year, above the Fed's traditional target, but stable relative to recent years. Let's isolate the metrics that matter most for real estate decision-makers. First, employment. At 3.7% unemployment, Atlanta's job market remains a primary asset. That translates to tenant demand, lease renewals, and occupancy resilience across office, industrial, and mixed-use properties. This isn't a market in distress. Second, the borrowing environment. A 6.82% 30-year rate isn't prohibitive, but it's meaningfully higher than the sub-4% levels we saw 3 years ago. That compresses cap rates and demands disciplined underwriting. For investors and developers, the math is tighter. Deals require stronger fundamentals. Third, inflation at 3. What's the trajectory? Let's talk about the medium-term direction. The Federal Reserve's 5.33% funds rate reflects a policy that remains restrictive by historical standards. That's intentional. The Fed is managing inflation without choking growth. For Atlanta, that means capital will remain selective. Investors are moving away from speculative acquisitions and back toward cash-flowing assets with near-term lease maturity. Industrial real estate continues to outperform because Atlanta's logistics ecosystem, anchored by the airport, rail infrastructure, and highway connectivity, generates consistent tenant demand and pricing power. Office properties face headwinds. The 3. RipplEffekt's Atlanta desk has tracked these metrics and trends across every property class and submarket. We've identified acquisition opportunities where disciplined pricing meets strong fundamentals. We've also flagged assets where market headwinds require active management or reposition strategy. Our team has curated a briefing that includes specific properties, comp analysis, financing scenarios, and tenant demand maps. Whether you're evaluating a core industrial acquisition, repositioning an office asset, or entering the multifamily space as a developer, we have the granular market intelligence you need. Visit us at RipplEffekt.com for the full intelligence brief.